This past week, we heard a fairly bullish medium-term view from Morgan Stanley, though even Morgan Stanley in the absolute near term is a little less bullish. Today, we are getting a slightly opposing point of view from UBS. UBS is worried about both the near-term macros like global slowdown, but they're even more worried about the rich valuations of Indian stocks. Ahead of UBS's investor conference, the top securities team joins us now. We have with us Tanvee Gupta Jain, the India economist, Sunil Tirumalai, the strategist, and Vishal Goyal, the head of research and banking sector analyst at UBS Securities. Gentlemen, and Tanvee, thank you very much indeed for joining us. Sunil, I'm starting with you because this is just an uppermost question in everyone's mind. I don't know if you have spoken to your global counterparts. Should we really worry about the, cryptocurrency meltdown, as it were? It's, gone down about 20% or $200 billion in market cap in the last couple of days. Will that have any cast any shadows on the financial markets?
Yeah, I mean, I think these are still developments which are unfolding. So I'd have to be a bit guarded, in my remarks because the published view from UBS needs to come out. But I mean, if you're looking at it specifically from the Indian markets perspective, I wouldn't really be, too worried about that. That's the direct rub-off onto the Indian markets is fairly, I would say, less. And even on a global perspective, yeah, I mean, I think so this is a lot of things that that basically played into it. I mean, including stress at some of the firms that are being questioned, etc. But I think overall, from an Indian market perspective, I wouldn't be extrapolating.
No, I take your point. Say, actually, on India, the RBI has been extremely conservative, so there's no question of any impact. I mean, globally, 1 year ago, they were a $3 trillion market cap. 2 days back, $1 trillion. So another 200 billion going away shouldn't impact, but still, one has to be wary of these things. Okay, now let me come to the India story proper. Tanvee, you're sounding a little more bearish than other economists. On the street, RBI is standing at about 6.2%, I think, for next year. And IMF is standing at 6.1%. But you are among the group of economists who are not even expecting 6% next year. Why?
Sure, Lata. So if you look at what's happening globally, I would say slowing global growth and a tightening global monetary landscape on high generalized inflation, what you're seeing in the advanced economies, having a material headwind for growth in emerging markets, and India is no exception. So if you look at what our global economics team is forecasting, we are forecasting a 2.1% YOY global GDP for 2023, which will going to be the lowest since 1993, excluding the pandemic and GFC. So while I agree with the fact that India is going to be the lesser affected economies due to the spillover effect of a global slowdown, our view is that it is not immune. So factoring in delayed impact of monetary tightening on domestic demand and a slowing global growth, we are estimating India's GDP growth to slow down to 5.5% for FY24. And I agree with you, the consensus is still at 6.2, where I do see that there could be more downside over the coming months, which will be visible on the numbers.
Okay, no, the consensus is not at 6.2. Only RBI is at 6.2, and I think Morgan Stanley is at 6.2. There are a bunch of economists who are south of 6. I think Citi is at 5.9. And I think Nomura is standing very close to what you are speaking about, 5.5. But that's a bit of a heartbreak when you hear 5.5 for Indian growth. Now, Vishal, therefore, to come to you, I'm actually dying to ask you banking questions. But before that, a general research question. How are earnings growth? The second quarter is almost done. What's the EPS growth for this year, according to you?
Yeah, hi. So, as you're aware, I think most banks have reported beat on earnings, mainly driven from NIM. And what we saw is upgrades in consensus earnings, mainly driven from NII. Roughly 5 to 10% NII upgrades, we saw across the board. Also a similar EPS upgrade, in consensus, earnings, we typically saw that. Now, EPS growth comparison generally doesn't help because a lot of EPS growth is coming from credit cost decline, some gets
No,
impacted
one
by
minute, one minute,
mark-to-market cost.
1 minute. I think I didn't make myself clear, Vishal. I will come to the banking question later. As head of research, I was wondering if you have an overall India EPS growth number. Last year, it was what, about 38, 39% EPS growth. What is the expected EPS growth for your entire universe this year?
Yeah, sorry. So I think Sunil is our India strategist.
Okay, sure,
so
sure.
I'm sure
Okay, over to you, Sunil.
Yeah, so let me just quickly, take that up. So, I mean, we don't have too much of a downside. So the worry for us on the market is more from a valuations perspective. And as far as earnings are concerned, I think we are having about 9 to 10% growth into FY23 and kind of similar kind of growth into FY24 as well. That probably means, some downside to where the consensus is. But I mean, that's, I think, par for the course because consensus usually does get cut through the year, right? Yeah. So, I mean, if you strip out that trend, I think we're not really talking about too much downside, on the earnings.
Okay. No, the big fall is from 39-40% last year to about 10%. From what I heard from a couple of brokerages, they are at 11%. So, you're not very far from the consensus right now. But Vishal, the biggest contribution, as you were speaking, to earnings and to prevent them from being downgraded have been the banks. What's your sense about how long the good run will last? Almost all of them reported 20 to 30 basis point improvement in margins. Are you expecting that to continue in the second half as well? When does it peak off and start falling?
Sure. No, it's a fair question. I think if you look at NIM trajectory, yes, we are expecting more NIM expansion in the next half, partly driven by the same repo rate, EBLR repricing. Also, I think the MCLR repricing, which is behind, of course, the EBLR repricing. So we've seen EBLR repricing of 190 bips, while the MCLR generally has gone up by 100 basis points for the system. So there is some lag, which will even come through from MCLR, which we feel would offset the deposit rate hikes, which also are happening and will happen, even further. But pointed question, answer to that is yes, there is more room for margins to grow, at least for next 2 more quarters. And again, depending upon how the competition intensity actually either it goes up or no in the next half, we would take another view on the FY24. Currently, we feel FY24 would be a flattish NIM, story. Of course, it will, you would see decline from Q4 levels, but on a YOY basis, you should expect a flattish NIM.
But what kind of...
In 24.
Got that. Okay, flattish NIM in 24, but there is scope for NIM expansion in the current year in Q3 and Q4. Vishal, would you bet more on the PSU stocks? The private banks are all at all-time highs, barring HDFC Bank. All of them are at all-time highs. State Bank and BOB also at 52-week highs, sorry, maybe not all-time highs. But the rest of the banking pack, say Bank of India, Union, and the rest are still some distance away from even their 52-week or 50-week highs. What's your expectations in terms of gains? Are you likely to make more money there?
Sure. So I think as we've been continuously maintaining, once in 10 years there comes an environment where there is very low asset quality problems or risks, right? And we are actually currently in an environment where rates are going up, supporting margin expansion with very little credit cost fears or downgrade risk from credit cost. That is generally an environment good for state-owned banks. And we also have our own, select, names in our pecking order. But generally, it's a good environment to own. I think the struggle with state-owned banks historically has been sustaining those metrics, plus the capitalization levels, which is, generally has hurt their, ROE performance over time. But clearly, if I had to think about in last 10 years, when was the best time to own state-owned banks? You can argue this is the best time.
Okay. Well, even a bank like UCO is at 52-week highs, something you wouldn't have expected. Sunil, where would your balance of preferences be? Of course, banks. Vishal has almost explained that very clearly. Which else?
So that's where we really struggle, right? I mean,
Okay.
our view is cautious, right? From a global perspective, you see that in spite of YTD, significant selling by FIIs, the market has held up, which is good. But going forward, that basically means that, I mean, from a global perspective, India is completely priced out. I mean, it's at the top of the charts in terms of valuations. And any incremental improvements in other markets or geopolitical settlements, I think it could lead to underperformance for India, right? I think what is holding up India, we've discussed last time too, is basically the really strong domestic flows, right? And I think that's where it kind of ties into what Vishal mentioned on margins, right? I mean, the deposit rates have been fairly low for quite some time, and my guess and our work shows that once deposit rates actually start normalizing and going up, that can have a meaningful impact on how the households start thinking about equities, right? So I think that's the worry I have at the market level. Yes, banks is probably the only place where we still see. I mean, as you yourself said, most of the stocks are themselves trading at at their peak levels. But that's probably still the only place at an aggregate level where we still see some value. But otherwise, we find it really difficult to find value. We would rather look for places to cut and get back in when the market falls.
Okay, not even hospitality, say Indian hotels, varieties, even over there, you would think priced out?
Yes, I mean, without getting into specific stocks, yes, I think if I look at consumer discretionary names, consumer staples names as well, I mean, I think all the reopening trades, I think it's all pretty much priced in for things.
Okay, you're going to have a difficult time in your investors conference explaining, but I guess people may be thankful if that's how it turns out. If you look at the
messages coming out from companies in our conference, it's fairly confident, it's robust. I think companies have done a fairly good job of managing the high inflation environment. Which is why, I mean, my worry is not on earnings, it's not on EPS, it's
fair enough. Fair enough. No, I take your point. Tanvee, I'm told we are running out of time, but the big worry for Indian macros has been the currency. Do you think, does your global team think the dollar has peaked off? Is there incrementally less worry on rupee, or are we still going to see a lot of depreciation?
All right. So if you look at on the INR, our year-end forecast is still at 85, and only in next year, that is in 2023, that we are estimating strengthening back to 82. So if you look at globally, our view is that entering 2023, as the US carry advantage and rates volatility fade more rapidly than in a typical recession, we are expecting dollar to slowly fall against the G10 FX. But, our global view largely is that the fall should be limited, however, by weak global growth, which is a key driver for dollar. So near term, yes, the currency headwinds for India should continue. We are estimating that in the near term, RBI will be intervening in the FX market to ensure an orderly depreciation of INR, and at the same time hiking policy rates. So the repo rate we are expecting to peak at 6.5% in this cycle. But I think the problems are only going to ease next year as the dollar begins to weaken.
All right. Thank you very much, Sunil, Vishal and Tanvee, for giving us a 360-degree perspective in dramatic contrast to the bullish view that we got yesterday and the day before from Morgan Stanley. But yes, it takes all sorts to make the market. Wrap up on Bazaar on that note. Chart Busters coming up next.